Capital Clarity. It is Thursday, March 5th, 3:07 p.m. A little less than an hour left in the trading day here. Rick, how's it going?
Good, good. I'm still riding that high from U.S. hockey winning the Olympic gold medal, both the men's and the women's. That was fun, huh?
Amazing, amazing. I was watching it up early, watching it that Sunday morning, and what a goal when
Yeah,
we survived that 3-on-5 power play, when America survived the 3-on-5 power play. Um, I went nuts. That was
how did
amazing.
Canada not score up two men for
I
that
accepted we
long?
were cooked. I accepted.
Yeah,
I'm like, they're going to score on this 3-on-5 power
yeah.
play.
How
I
did that
couldn't believe
happen?
we fended that off. Yeah. Yeah. So much
Yeah,
fun.
it was
So much
impressive.
fun.
The other thing I saw is that that game started between 5 a.m. and 8 a.m. in the U.S., depending on where you are in the U.S. And NBC had 26 million viewers.
Shh. 26 million. That's, yeah. I mean, I was one of
26 million.
them. Start to
Yeah,
finish.
20. That is amazing. 26 million viewers for a game that starts at, early in the morning. So pretty
Yeah.
impressive.
Yeah. Well, I know it's been little while since we've recorded. We've been busy, good kind of busy, but busy nevertheless. Lots happened since we recorded, other than just the hockey game, and I think I'd be, we don't talk really at all. We stay away from politics on this podcast. It's just not us either. But I think I'd be a little neglectful, whatever the word is, if I didn't mention the Iran news and how just because we've been getting a lot of questions on how that might impact the market. And really, when you look at other events like this in the past, and I'm going to share my screen here. Uh, this is a chart that just shows the Dow Jones over the course of time since the year 1900 and different different major significant negative events that happened along the way, starting with the San Francisco earthquake way back in the early 1900s, and then ending with around the 20 early 2020s that we're in right now with the European debt crisis, Russia, Ukraine, Hamas, Israel, COVID. And if you're listening along the way, and this chart is from Carson Investment Research, along the way, the market has it's had hiccups where it's gone down short term, but in the long
Of
term,
course.
like it's going to do in the long term, it's just gone up and it's ignored all of these negative, horrible events that seemed like the end of the world when they were happening, and that makes sense. We're humans. We assume, our natural instinct is to think short term and think that each time is different than the last, which is what we're going through right now. But eventually we'll get through this and we'll look back and say, hey, this really, in the grand scheme of things, for the stock market, didn't matter.
Yeah, temporarily it's frustrating. And it does make stocks, have a tougher hill to climb. But yeah, no, you're right. Here, when you're done sharing, I got one to share that's kind of
Go
similar.
for it.
A little bit shorter term, um, going back to 1940. So this is an image from also from Carson Research. Um, and it goes to 1940, and it shows a lot of the similar events that you had on your chart. And so, like, for example, the Kennedy assassination's on here. Well, 12 months after the Kennedy assassination, the market was up 23%. It's pretty impressive considering the President of the United States was just assassinated in public. Um, the Iran thing's a war issue or conflict, however you want to define it. But you look back at the Iraq War that started in 2003, and a year after that war started, stocks were up 30%. So I think, as I look at this image of all these different events, major geopolitical events from 1940 till 2026, I think the key takeaway for me is that it really depends on what kind of footing you're starting from when the event occurs. Are you in a recession, in a bad economy, already in pain when that starts? That makes it harder to recover from. So if this Iran war starts and we're already in a recession, I'm a lot more concerned than we are today because we're not in a recession as of right now. So it's likely we're able to take this kind of shot and recover from it and do better over time. The odds are higher of that occurring because you look at most of these incidents on this chart, and the ones that really kind of lingered were ones that happened when we were already pretty much beat up and in a recession. So yeah.
Yeah, yeah, exactly. And listen, are people's questions and fears well founded? Yes. In the short term, there can be volatile movements during moments like this, but in the long run, are we really going to get down the road, 2, 3, 4 years from now, look back and say, wow, that Iran conflict in 2026 really had a long term impact on the stock market? Probably not.
Yeah.
Just like all
And
these other ones.
here's the other thing too. Remember, if your portfolio management process and your financial plan do not expect these things to happen and budget for them, plan for them, have plans in place in advance of them occurring, then you're just not really being realistic. This is part of the world we live in, and you have to have a preset of plans in place for when this occurs, knowing what you will do and won't do. The won't do part's often even more important. So you have to have, you can't just say, well, this won't happen. No, it's going to happen.
Yeah.
We won't see it coming, and it'll be horrible and tragic, but your portfolio management process and your financial plan should budget for it in advance.
Exactly. Gonna stay on the stock market here. I've got this piece from Creative Planning. It shows, hey, if someone sat all in cash, not invested at all, just all in cash in the US dollar, what would that do over the course of 1928 to 2025? So huge amount of time. What would that do on average versus the S&P 500, the American stock market? Well, it shows on average that during this time, almost 100 years of time throughout the 20th and 21st century, if you were on average 1 year in cash versus invested in the S&P, you'd be down 8%. 2 years down 18%. It goes on from there, but the numbers get really crazy when you get to 20 years. If you sat in cash for 20 years versus the average returns of the S&P 500, you are down 673%. 30 years. If you're in cash for 30 years versus the average returns of the S&P 500, you are down 2,040% on average.
Yeah, it's
Just
just
a wild
basically
chart to see.
screams stocks beat cash over time, and the more time you give it, the more they've beaten cash.
And
Yep.
I show this to say, I know it seems safe being in cash. Hey, I'm not losing anything. I have the same amount I started out with, but you're bringing a fixed amount into a rising income inflationary society. So even though you can't see the minuses go down on your checking account or on your savings account if it's all in cash, societally you can see by the average price of things going up over time as your bank account doesn't. And that's what
Yep.
this is.
Yeah.
Yeah.
Yeah, it's cash is usually not a long-term solution. We all need some cash. You need it for short-term stuff, but peace of mind. But with the Iraq thing, one of the big
Iran.
or Iran, thank you. One of the big issues has been the price of oil because price of Iran's maybe I think the fifth largest producer of oil in the world, might be sixth or fourth, somewhere around there. And so obviously with a war going on there, it spikes the price of oil. I mean, if we look at oil, crude oil, since the war started just a scant few days ago, I mean, oil's moved up from $65 a barrel. Right now it's around $81, $82 a barrel. That's a really fast spike in the price of oil, really, really fast. And we've seen this before. This image I'm showing is from Ritholtz, the compound. And what it's basically asking is, hey, after crude spiked up significantly, what did the S&P 500, the stock market, do 12 months after that? And this was surprising to me. The median S&P rally 12 months after 2 consecutive days of 5% crude oil spikes is 22.7%.
Wow.
So higher and higher by a lot for stocks after this happens. It just doesn't seem to jive with my brain, but these are just data going back to 1990. The other thing is the average win ratio, the amount of times that stocks were up 12 months later is 83%. So it's pretty impressive. I mean, I don't have any logic as to why that's the case. Maybe it's just, hey, stocks go up over time, but that's a pretty big go up number and a very high win rate of 83%.
It really is. And that's a lot of data. That's a lot of time. That's over 30 years of time.
Yeah, it's pretty impressive. So we'll see what happens now. The fear with crude oil spiking, of course, that is it creates inflation.
Yeah,
So interest
exactly.
rates going up a little
Which
bit
causes
too,
rates
so.
to go up. Yeah.
Yeah.
I'm going to shift over to real estate real fast. Interesting. Something on the home front right here in Philly. This is from homes.com. Philadelphia sees largest annual increase in home prices. Out of all
Really?
these metros listed on this list, which if you're listening, I won't list them all, but it spans from Philly to Detroit, Cleveland, Columbus, Baltimore, Cincinnati, Chicago, Miami, Salt Lake City, Richmond, San Diego, Tampa, Minneapolis. You get the idea. A lot of cities. It shows these are the numbers for January of 2026, so year over year numbers. So from January 25 to January 2026, it shows that Philadelphia's home prices on average increased by 8.6%, which is the highest on this list. Second to that
Wow.
is Detroit at 7.4, and then Cleveland, Ohio at 7.3. The ones that decreased at the very bottom, San Jose, California, down 3.3% year over year, January 25 to January 26. Seattle, Washington, down 3.8% during that time, and then Raleigh, North Carolina, down 4.3%.
So Philly, Detroit, Cleveland, and Columbus, Ohio, and Baltimore, top of the wins, up the most in the last year. Is that our retirees retiring in Philadelphia, Detroit, Cleveland, Columbus, and Baltimore? Is that what's happening? Is
I
that
don't
why
know
the prices
what
are
this is.
up?
I really actually saw this chart and I couldn't make any sense of it. I genuinely
Yeah.
couldn't. So I bring it up to you to say, can you make sense of it? Because I can't.
Yeah, it's a 1 year period. It's not a big data set, but
It's a very small sample size. Yeah, or
yeah,
data set, I should say.
I don't think people are saying I'm retiring to those places. It's maybe, but I doubt
Just
it.
interesting
We
to
know that's
see,
not
though.
happening.
Yeah.
Yeah. Well, I see like is Austin on here? Austin, Texas.
Austin,
So
Texas is down
yeah.
0.2%.
So it kind of tells me, Austin had a huge run in during COVID and coming out of COVID. So if I on this chart to see Austin down kind of tells me that maybe it's just, this is reversion to the mean. Austin had such a run, and then now it's just kind of some of the airs coming off the top. And maybe, I don't know, but maybe Philadelphia, Detroit, and so on kind of lost value, and now they're just recovering from some of that, and again, reverting to the mean. I
Yeah.
don't know. That's a
Yeah.
guess, but
Could be right.
possible. So on real estate as well, I feel like we're picking on Canada with U.S. beating them in hockey, but I saw this exhibit from Corpay before the hockey game. So just for a full disclaimer, but
Not
basically,
intentionally trying to beat up
no,
on
I'm not
Canada.
piling on.
Adding insult to injury.
The title is Canada's housing downturn is the deepest among major economies, and it measures data on home prices, residential home prices from basically 2022 to 2025. And Canada's median home price has fallen 18% over those approximate 3 years. That's a lot. I mean, 3 years down 18%. That's a lot. I mean, that's tough. On the opposite end of the spectrum is homes in Mexico, Poland, and Spain are up in the mid 30% areas. So kind of interesting. We don't really think of real estate outside the United States because we're United States based, but it's interesting to look at it from a global perspective.
It is, and I'm no real estate expert, but I'm sure it would probably be pretty fascinating to dive into the intricacies of how each real estate market works, because I'm sure that's something that's different drastically from country to country. You know?
Yeah. So I we talked about reversion to the mean on your 1 year chart of cities in the United States. Well, I know a lot of this is, I don't know about Mexico and Poland, but I do know Canada. It's mean reversion. I mean, Canada's home prices went up so much for so long, and it just feels like, okay, they're down 18%. That's not fun. But that's after tons and tons of gains. It's you buy a stock at $100, it goes to $250, and then suddenly falls to 220. Sure, I'd love to see it back at 250, but it ran all the way from 100 to 250 in the first place. It's just taken a little bit off the top. So
Exactly.
probably
Yeah.
what's
Some of it
happening
can
in
be
Canada.
technical analysis and not necessarily fundamental, I guess.
Yeah.
So still staying on housing. This is for America, not outside of the U.S. From Mike Simonson. Mike
Simonson?
Simonson. I always do that with people's
I'm
last
guessing.
names. I'm so bad
guessing.
with people's last names. So this is data from Altos Research and Compass for single-family homes. The inventory change in each state from 2019 to 2026. So, the COVID era to the post-COVID era we're in right now, I guess, showing basically, hey, where is housing inventory drastically going down for single-family homes? And I think you can kind of guess it. The Northeast is seeing drastic decreases. Pennsylvania down 45% in those
And
six,
this is
7 years.
inventory, so the number of homes for basically sale,
Yeah, not new builds, just total, for sale.
total available
What's
for sale.
what's gone down since 2019 to present
So in the
day.
Northeast, you're seeing a lot less inventory for sale. If you're trying to buy a home in the Northeast, it's a lot harder because there are a lot less to pick from, right?
Yeah, exactly. And whereas in the South, you're actually seeing an increase in inventory, and then Texas, you're seeing a 42% increase in inventory over those 6 or 7 years.
Wow. Yeah. Yeah. COVID COVID whacked a lot of stuff. It changed a lot of patterns and behaviors that were entrenched for decades. It's wild to look at a lot of data pieces like this and then try to remember that that's what happened, because these are numbers changes that are usually if you pull up this image, it's very mild and boring. And look at some of these numbers. I mean, 42% plus to the plus side in Texas is amazing.
Amazing.
And what's the other? Arkansas is plus.
I was going to say,
60
I'm so bad with geography down there. What is that one that's at 62%?
That's Arkansas.
That's Arkansas? Okay. I'm sorry.
Anybody want to
Arkansas.
move to Arkansas? There are a lot of houses for sale.
I'm sorry, Arkansas. I didn't know where you were on the map.
Hey, I don't have an image for this, but I had to get a trust document notarized the other day. It's just an observation. I mean, it seems so antiquated. So I got to get it notarized. The closest notary's at a UPS store in Doylestown. So I go to the UPS store and I sign it in front of the notary. They stamp it. I pay them and I walk out. And it seems so crazy. It's like, this really important trust document has to be notarized. So, all right, well, how can we give everybody involved great peace of mind? I know, have Rick sign it in front of a UPS employee. That will make everybody feel great.
Yeah.
Ridiculous, right? It's one of those things where it's just, I don't know if anybody else has felt that way, but it's like, okay, I guess this is what we do. It's still the universally accepted standard of
It's
transparency.
allowed. It's legal. It's allowed.
Yeah.
No,
All
you're
right,
right. You're right.
All right, so
Yeah.
enough of my observations. So I found this. It's about streaming services. So this is an image from MVPD. So it's basically a piece showing the churn rate for popular streaming services. So churn rate is, we signed up a subscriber, we lost a subscriber. If you sign one up and somebody else drops the service, you've got a 100% churn rate. 100% of your people that you signed up left. And so obviously streaming services, Peacock, Stars, Apple TV, Disney Plus, Netflix, they all want as little churn rate as possible. Most of the streaming services, other than Netflix, have a churn rate between right around 4% and 10% a year. Netflix, since 2023, has pretty much been down around 2% or sub 2%. So basically, people sign up for Netflix and generally don't cancel it. Whereas, something like, well, Stars, I don't, but Peacock, they turn that on and turn it off. HBO Max,
Look at
even
Hulu.
Paramount. You've got a lot of people, turning on and off streaming services. I'm canceling my service.
Netflix stays pretty steady, huh?
It's amazing how it's funny, I don't have all these streaming services, but Netflix is probably the toughest one for me to turn off.
Well,
if I had to ditch them
yeah.
all, that's the last one I ditch.
I wonder if there's some sort of a correlation with a low churn rate for how much content's put out, because Netflix pumps out content. I mean, they have something new every single day, whether it's your taste or not. And it just seems like they put out so much more than other services. And I don't mean, hey, they upload more existing movies or TV shows. They create new movies and TV shows that are hits every week, it seems like. And so I wonder if that's why, because people will say, well, I don't know, I don't want to cancel Netflix because I want to see what they put out next week or something,
Yeah. Remember they still are, but remember when they first started spending billions and billions of dollars on their own content?
Yeah.
And they didn't have billions of dollars to spend. And I remember a lot of us were saying, this is insane. You can't burn through all this cash. This isn't going to work. You guys are supposed to be a platform that takes other studios' content and puts it on yours. Well, it worked. It sure worked. Yeah, it's pretty impressive.
They did it. Yeah. You watched that movie The Rip, right, with Matt Damon, Ben Affleck?
I actually loved that movie.
I
I
went
get
into
it.
it with
Netflix.
very low expectations, and it was good. I thought it was a
Maybe
good
that's
movie.
why I loved it because I had low expectations, but it was fun.
I think that's a lot of people though going into Netflix stuff is they say, "Ah, I'll give it a try. It might not be good," and they finish it and they're like, "Oh my goodness, that was no. I'm watching that again." You know?
Yeah, that was fun. It was a whodunit. It was Good Will Hunting too because it
Yeah,
had Matt Damon and Ben Affleck in it. Right?
yeah.
It was
Well,
not Good Will
not
Hunting
exactly
too.
Good Will Hunting. Yeah.
No, it had none of that plot.
This can get a little boring, but I thought I would share it anyway. This is from October 2025 to January 2026, and it's from this is from Charlie Bolello, his blog. It's the cumulative receipts, outlays, and surplus slash deficit through fiscal year 2026 so far. Basically showing for the federal government, basically showing if you're wondering why we have a deficit, here's a small time frame showing a pretty good example of what we're taking in as a federal government, what the federal government's taking in the money they make on taxes, Social Security, and retirement,
So most of the money
you
they
know,
take in comes from
and then miscellaneous expenses and what it goes out as. And this is
right.
a perfect breakdown of here's why we're in debt as a country.
Yeah, so like the two big ways the government makes money is income taxes and us funding Social Security and Medicare funding. Us paying out of our, for example, our paychecks, income taxes, Social Security, and Medicare, Medicare costs out of our paychecks. And you look at what we're spending it on, the vast majority of it's going to really kind of four things, and it's really the top three. Social Security payments to retirees, mostly retirees, Medicare costs, mostly to retirees, and net interest, which is interest on our debt.
Look at
That's the
the
third
interest
one.
we're paying on our debt. The interest we're paying on our debt is bigger than our national defense budget.
Yeah, we're paying $346 billion during just this one little period.
It's more than double the size of the veterans benefits and services.
Yeah, yeah.
That's
It's one of the reasons why the federal government would love to see interest rates lower because it makes that interest cost go down. It's like having an adjustable rate mortgage and having your rate adjust down.
then
You
inflation's got
know?
to go down. So that means
Yeah,
you got to stop printing money. And that way
that's the
inflation goes
thing.
down. That way rates go down,
And
you
the
know?
only way you
Yeah.
stop printing money is by stop spending so much darn money. I
Yeah.
mean, it's pretty simple. Most people
We
who run a household budget know that.
we don't want to get into the weeds on this because we don't get into politics, but one of those things where it's just math.
Yeah, and it's not even politics.
No.
Almost every administration has spent money like a
But
drunken sailor.
no one wins elections by saying I'm going to spend less money.
No, I mean that you're not going to win the election then.
No,
You got to
exactly.
promise people stuff.
Yeah,
Yeah,
yeah.
I don't know how to fix that. That's bigger than me.
Just interesting
So
to see the breakdown, in my opinion.
so something you know, I've got this piece from John Latten on AI because everybody, 2 or 3 weeks ago there was a piece from Trini Research that basically said, AI is going to collapse society. I mean, I'm being hyperbolic here, but AI is going to collapse society, wipe out most people's jobs, especially white collar work and so on. And John writes this piece and says, but people have adapted through, I'm just going to read from it real quick. People have adapted through every major technological shift, despite fears at the time that they wouldn't. AI is different, yes, but history still contradicts the doomsday narrative. And I'll just pull out a few he gives examples of. The printing press in the 1400s, scribes, people who wrote stuff on paper, said we're going to lose our jobs, and instead literacy surged and information spread more widely and society grew. Industrial revolution in the 1700s and 1800s, machines replaced manual labor, but factories grew, cities expanded, and new jobs were created. Railroads, imagine how many people thought we're going to lose our, horses, canals, all those kinds of things, they're not going to use those anymore. Well, it also led to a lot of benefits. The broad use of electricity, the telephone. Imagine being a telegraph operator. This telephone's put me out of business. Of course, there were more benefits than. And for each person who goes through one of these phases and is a telegraph operator and loses their job, I'm not trying to minimize that. It is brutal, but it's just generally humanity finds a way through. Look at computers in the 70s and 80s when they started being implemented, especially in businesses first. I mean, clerical tasks started to go down, but then all this work comes in the way of software, information technology, digital work, and so on. It's just there's always the next thing that's going to create fear and definitely job loss and hardship and so on. But humanity tends to adjust.
Yeah.
I mean, he puts here, history hasn't failed yet. And maybe I'm being a little too optimistic and whistling past the graveyard, but I'm going to bet on optimism over pessimism and the human spirit fighting through.
You know,
Go ahead.
I was gonna say I was reading something on social media this past week about old jobs, and I don't mean old jobs as in like, 20 years ago. I mean, 17, 1800s. And some of them were interesting. The one was, I'm going to mess up all the names, so I'm not going to say the names. Lamplighter was the one. Someone had to go light the lamps on the streets.
Yeah.
And then the other was basically a human alarm clock, where
Yeah,
if someone,
yeah.
someone would have a big stick and they'd go to people's windows and bang on the windows in the morning when it was time for them to get up to work because alarm clocks didn't exist.
I mean, it makes sense. So
the other one
I always
was,
wondered that. How do you wake up when there's no alarm clocks and you got to be up?
Yeah. The
You
other
pay a
one
guy.
was a person who would literally stand in a crowded area, a workplace or something, and read a whole book out loud. And you could just go over to him and listen to parts of the book or the whole book if you wanted to. But he was just paid to go read a book every day for entertainment.
That's funny. Yeah, that's basically like going to a movie now. It's storytelling. That's
Anyway,
pretty cool.
so you just reminded me of that with what you said.
Yeah, very cool.
You were
All
going
right,
to pull up a chart.
Nah, let that go. I'm good. It's beating a dead horse on the AI thing. We'll move on.
All right. I got one more thing. I saw this today and I thought this was interesting. From 2019 to 2020, sorry, this is from the Visual Capitalist, from Voronoi. The states with the fastest rising incomes from 2019 to 2024. Just thought this was interesting. And really, I think goes as a testament to remote work, because look at Colorado with a 47% increase in income and median household income from 2019 to 2024. Montana at 36% increase, and Texas at 21%. And Georgia at 43% increase. And the Northeast is not is close to those numbers, but not like those numbers.
Yeah.
I think this shows,
Colorado
hey,
plus
here's
40.
people with high income, high household income, median household income jobs where people can, be based out of New York or Philly, but work in Colorado remote or Montana remote,
Yeah.
Look at Alaska up 16%.
This is interesting. Huh.
Look at Maine up 36%.
Right.
A lot of this too is probably, hey, I work in New York technically, but I want to live in a lower tax state. So
Yeah.
why don't I just work remote in that lower tax state?
I was thinking that. That's what I'm trying to make sense of this. But then you look at California. California's up 29%. Not that that's top of the leaderboard, but people are fleeing California, and yet they're not at the bottom of the leaderboard here. So this is Colorado, huh? Interesting.
Yeah.
It's just simply fastest rising incomes, nominal change in median household income. And Colorado leads the way, and Georgia's pretty close behind. Interesting. I feel like I need to dig into this to understand it better, but I love Visual Capitalists. They always bring good stuff.
This was a really cool chart, I thought. But yeah. That's all I had. I'm trying to think if I've been so busy I haven't been watching a whole lot of TV or reading lately.
All right,
Soon
I
will.
got something.
But what do you got?
Last night I went and saw in the theaters, which is so nice. I haven't been to a theater for a movie in so long, and that's my fault. There have been some ones I could have seen, but we went and saw Crime 101.
Is that like a crime movie, I'm guessing?
Yeah, it's a heist movie set in L.A. that's drama, suspense, action. It's really well done. Chris Hemsworth, Halle Berry, Nick Nolte.
That's a pretty stacked cast. I didn't know.
Yeah.
I've never heard of this movie.
And Mark Ruffalo's in it too, and he's great in it. But Nick Nolte, he's always so fun to watch. I mean, ever since 48 Hours with Eddie Murphy decades ago, I love Nick Nolte. But Chris Hemsworth's the main star, as well as Halle Berry and Mark Ruffalo too. It's really well done. It's fun. It's about 2 hours and 15 minutes or somewhere around there. And, it's worth it. Like, it was very worth it. It had me invested in it the entire time. They wrapped it up with a little bit of they didn't wrap it up with a bow on it. And I know you don't mind that, but that bothers me.
Yeah,
Like,
that's been like that. Yeah, that's been a new theme of movies lately, and you don't like that. I know.
No,
Yeah, you need there to be a happy ending.
I don't care if it's tragic or happy. I don't care, but wrap it up. Or if I know you're going to do a sequel and you don't wrap it up, I get it. There's going
It's
to be
funny how
another
that
one.
bothers you. I like
It
how
does.
that
It bothers
you.
me. And it's funny. I was talking to a few people as they were coming out of the theater. They're all saying the same thing. It was really great till the end. The end was fine. It's just you just kind of the credits suddenly roll, and you're like,
Yeah.
all right, I'm
Did
going
it?
home.
Did your mind break when you watched the final episode of The Sopranos way back when?
That bothered me. That
Yeah, I
bothered a
bet it
lot of
did.
people. Yeah, that bothered a ton of people the way The Sopranos ended, because it just ended like, it's frustrating. They're playing Journey and
Yeah.
on the jukebox in the diner, and they just roll credits.
You told me to watch The
nuts.
Sopranos about 2 years ago, and I did. I watched the whole thing. I binged it one winter, and I got to the final episode, and that happened. Where spoiler alert, guys, at the end of The Sopranos.
Yeah, if it's a spoiler for you, then it's been
Yeah.
so many.
It's
long now.
left on a severe cliffhanger where you think anything could happen, and the screen just goes dark. And I actually thought, because I had the lights off when I watched it, I actually thought my power went out or my TV got turned off, and then I just see the credits come up, and I'm like, no, that can't be it.
Yeah, it was a
Yeah.
great show. One of the best shows ever. I love that show. I've
Yeah.
rewatched that whole series a few times actually. That's how much I love it. But yeah. The
Tell you
last
what, I
episode.
will be watching this weekend, and you can make fun of me for it if you want. But they made yet again, and it's on Netflix, another Jurassic Park.
Oh,
So
did they?
yeah, I don't know if this is like 8 or 9. It's becoming like the Fast and Furious movies now, but they'll keep making them. It's dinosaurs, and I'll keep watching the dinosaur
They lost
movies.
me.
Yeah,
Yeah,
no, I'm
I
good.
just-
I'll keep watching them.
I'm usually like that. I'll watch all the Fast and the Furious, but they lost me with Jurassic Park. I guess maybe, who knows, if I'm bored, I'll watch. I'm not going to theater for something like that.
Oh no, it's not in theaters. It's on Netflix. But
Oh, Netflix.
while I'm
You know,
cleaning or something, I'll pop it
we're
on.
walking through the theater, and I saw they got Toy Story 5 coming out. I think I stopped at 2.
Yeah,
I don't think
I didn't know they made a fourth or a third.
No, and somebody said that Tim Allen's going to be back in this one. I didn't even know he wasn't in the last 2. I didn't even know there were 3 and 4 in the first. I lost track, but
Yeah.
I guess
Yeah.
that's what happens when your kids grow up. You don't see those movies as much.
Yeah. Yeah. Well.
That's why
All
I
right.
missed Frozen, because I didn't have young kids or daughters, whatever, for Frozen. So, all right, cool.
Thanks again for joining us, everybody. Please keep sending us questions. They've been great, and yeah, we'll see you next time.
All right, bye, everybody.
The Capital Clarity podcast is presented by FA's Keith Wagner, AA, MS, Financial Advisor, and Rick Wagner, CFP, Senior Vice President, Wealth Management. This podcast is for informational purposes only and is not intended to be taken as financial advice. All opinions expressed are of the hosts and do not necessarily represent those of Raymond James. Opinions are as of this date and are subject to change without notice. Investing involves risk, and you may incur a profit or loss regardless of strategy selected. Prior to making an investment decision, please consult with your financial advisor about your individual situation. 2003 South Easton Road, Suite 100, Doylestown, Pennsylvania 18901, 267-742-3455, Raymond James and Associates Inc., member New York Stock Exchange SIPC. The S&P 500 is an unmanaged index of 500 widely held stocks that is generally considered representative of the U.S. stock market. The Dow Jones Industrial Average, DJIA, commonly known as the Dow, is an index representing 30 stocks of companies maintained and reviewed by the editors of the Wall Street Journal. Inclusion of these indices is for illustrative purposes only. Keep in mind that individuals cannot invest directly in any index, and index performance does not include transactions, costs, or other fees which will affect actual investment performance. Past performance does not guarantee future results. 529 plans come with fees and expenses, and there is a risk they may lose money or underperform. Most states offer their own 529 programs, which may provide benefits exclusively for their residents. Please consider whether the state plan offers any tax or other benefits. Tax implications can vary significantly from state to state.